Hello, and welcome to Fireside with a VC. My name is Andrew Romans, and I'm very excited to have my good friend Garrett Goldberg on the podcast. Garrett, good to see you.
Andrew, appreciate it. Appreciate you having me on here.
Yeah, I know, it's good to see you. So Garrett is a partner at B Partners. I guess it's been over 7 years now, and I think this would probably put you in the zone of a fundpreneur because that fund really got started with you there at the very, very beginning. And you guys really focus on pre-seed investing, headquartered in San Francisco. In fact, I know you're in your office today. That's makes you exotic these days in the middle of COVID
Nice.
in a hanging presidential election. But Garrett, why don't you tell us a little bit about your background and how you found your way into venture capital, and then share with us the strategy at B Partners.
Yeah, I appreciate that, Andrew. Fundrepreneur is a good one, right? Because at this point, 7 years in, you're trained as a VC. You're starting to recognize patterns. The cycle has come back around, and so you should be able to see what came before you. But to get here, I certainly took the path less traveled. Well, I went to Stanford as an undergrad. I went and worked in professional sports and real estate. Didn't even know what really VC was, ironically. Found that through a local angel group in Idaho, where I'm from, and started at the ground up. Did the traction section on a due diligence report for the old gray hair guys there, and eventually became the screening committee chair, and carried on into the big leagues here in San Francisco. So, this is certainly part of the life's journey and my life's work.
So B Partners invest pretty early stage. So how many companies do you end up with in one single fund portfolio,
Yeah,
vintage by vintage, to
or
kind of adjust that risk?
this is something we spent a lot of time on, my partner and I. Fund two had 24 positions. There's really two strategies in early stage investing, kind of barbell. You either do a concentrated portfolio approach, 24 like us, or you do, it's called a spray and pray. That's a derogatory comment for the maybe 80 companies approach. In the middle seems to not generate outsized returns for the fund. So you either want to have a meaningful ownerships in these companies, and if one of those 24 goes to $1 billion, you'll be in business. Or you have 80 companies, you base it on your network and your exposure and access here in Silicon Valley. Several of those will go on to be $1 billion, and you own 1% of those. And so that adds up as well. But we talk a lot about fund construction, especially relative to reserves and follow-on capital into hopefully what are our winners. And so we take that concentrated portfolio approach here at B.
So if you're in 24 companies, what stage are they at when you get your first bite into that company? Are they pre-revenue? Are they just starting? Do you have a specific MRR or ARR you're looking at?
No, we don't have MRR, ARR targets. Generally, they are pre-revenue. We joke around the office that it's delightful when we can actually get a product demo, because oftentimes we don't have that luxury of a product demo. So these companies are really early. Sometimes we will get to see some revenue numbers, early pilots, but to truly have MRR, that's not what pre-seed investing is all about.
Okay. And so what would an initial check size be?
Sure.
And how much, what's the typical funding round? Because
Yeah.
pre-seed, for those that are unfamiliar, is very highly syndicated in Silicon Valley and pretty much everywhere.
Yeah, that's right. It's very, very cooperative, competition and cooperation at the same time. Generally, the pre-seed round of today is $1.5 million and less. Was the seed round of before. As fund sizes have gotten bigger, more liquidity into these different into the venture asset class as a whole, but then into the different stages, funds have moved a little downstream. What was a Series A is now kind of a seed round. So $1.5 million or under, we'll write $750,000 checks for 10+%. You can do the math. That's a $7.5 million post-money valuation. That would be a more mature company at the pre-seed, one that potentially has pilots, has some early customer interest, versus being pre-product and just a team with a spreadsheet or a PowerPoint. So we will run that gamut up to sort of $1.5 million, up to product in the wild a little bit. But we're certainly the earliest of investors in the venture class.
Okay. And so if you're investing kind of pre-product, where it's team PowerPoint and you've got some conviction around what they're working on, are these convertible notes, or are you able to say, hey, we're leading this, we're writing a meaningful check. We want to do a price round.
We prefer price rounds at B. It aligns us with the company. We want to be shareholders. We are shareholders. So we've done them all. We've done convertible notes and we've done pre and post money safes. Each has some benefit, but really it's all about alignment and accountability. That's what we're doing here. We will talk about boards later on in this conversation. I just think that's an important thing about being an early stage investor, especially if we take that concentrated approach. I don't think you could take the 80 company portfolio approach and have the same conviction around the investment type. But at the 24 companies, we have bandwidth to sit on boards. We prefer to be shareholders when possible.
Right. And I've had some surprises over the years that I invested in a company where the cap on the convertible note means I either converted a discount of probably 20% to the next pre-money, or if it's above this specified cap, then I should convert at that cap. But then later you see an employee stock option plan gets dropped on top of you, or what? And some lawyer is saying the denominator is just getting bigger and bigger, and you're investing it
Happens all the time, Andrew. Happens all the time.
Yes. So what have you learned around things that maybe surprised you once, but now you see it coming?
Be a shareholder.
Yeah.
So the company know price per share. A new vehicle that's kind of going around of late is the post money safe. And in the language of the post money safe, it calls out the denominator, as you say, to include unissued option pool, all the things that might dilute you unknowingly in a convertible note at the time of conversion. So the post money safe has been created to try to protect against that. But again, it's a safe is a simple agreement for future equity, and it's just that. It's very simple. There's no protective provisions. When we, as major lead investors, do post money safes, we will have a side letter that lays out some sort of accountability, some sort of protective provisions for us as a future shareholder, and oftentimes calls for a board seat, pro rata rights, things like that.
Yeah, because I think it's odd that you sometimes have almost teenager high school dropout founders or undergrad dropout founders with very little experience, but they're hopefully the next Mark Zuckerberg, and the money comes in from all kinds of people at some demo day, and they look like party rounds, and there's no kind of one benchmark lead in there, and there's usually no governance provisions to the transaction. So you end up with no board of directors really, or the board of directors are the two founders or the three founders. What with your side letter agreement, can you give some specifics? I mean, I want people to walk away saying, I want B Partners as my seed investor more than anybody, but it does make sense what you're putting in these side letter agreements, like at a minimum information rights. Like what are some of the things that you ask for?
Yeah, these are the right questions, right? Because I would certainly not have trusted my 22-year-old self with $1 million. The side letter is a function of not being a shareholder. So first, we prefer the priced equity rounds, and
Right.
most often we do a priced equity round. So if we end up in a scenario where we're doing a post money safe or convertible note and we have a side letter, if we're on the board, the board is about accountability and establishing an organizational presence inside the company. I do not want to run the company. We're here to be stewards of capital and deflect capital to the right entrepreneurs and the right opportunities at the frontier of technology. My job is not to be the CEO. And so sometimes we'll get founders that say, oh, I don't want a board. You're going to tell me what to do or tell me that I can't pivot. That's not what boards do in general. And that's certainly not what we do at the early stage. When we are on the board, we do a lot of drag reduction, we call it internally. There's a lot of stuff coming at a founder. The things that we can deflect, take off. Hey, we've interviewed these 10 firms. Here's the 2 that might be right for you. We save you a bunch of time. And so as a board director, and keep in mind, it's usually 3 of us with me as the minority, and we have the 2 founders. So it's not like we have control anyway. We really look at it as a way to gain transparency, two-way transparency, two-way access, accountability to each other, right? Because we do pride ourselves on the portfolio work we do. We can only do that if we have the right information, if we have that foundational layer of data information. So it builds this foundation on which to then go forth for the Series A and B when you really do have a board. you're established. You've done it before. It's not the first board meeting you've ever held. That organizational presence seeps into the company, into the board, and it really serves our companies well, the Series A.
I think it's good to formalize communication. Communication in a marriage, in any relationship, is important. And if the founder is communicating with you on a regular, periodic basis, you're better able to help before it's too late, in certain things. And
Right.
just formalize, keep an eye on what's operating expenses, what's monthly revenue, what's cash in the bank,
Mhm.
how much runway have we got here. I
Yeah,
think it's good to.
it forces the founders to do that they know they should do anyway. This stuff is important, but sometimes not urgent. And so, not that we need to create a false sense of urgency, but to get on that cadence and to start flexing that muscle of, hey, every 2 months we're gonna need to just look at our cash position and our runway. It starts to train that muscle and to build it, so that it can become an asset to the company, not a
Mm.
liability. And I obviously take my board work really seriously. I host a quarterly session on becoming a better board member for us up and comers that like there's no playbook or there's no class for this, and we bring in an experienced VC to talk to us about a specific topic on the board, because experience is the best teacher here. And so we're trying to get the later stage firms to tell us what they want to see and how we can do a good job at the early stage,
That's great.
hand off. And so, that's part of the co-opetition and the venture ecosystem we live in here. That's so great. Um, but if you don't get it going early on, it only gets harder. And problems exacerbate, and all of a sudden you got to spin up a board for a Series A, with a brand name firm. If you haven't done it before, that's a little scary.
And how many board seats are you on, and what's the right number
Yeah.
for, one person without going crazy?
That's hard. I've been on as many as 9 at one time. I just stepped off of 2 to go to an observer. The rationale being that we've pulled on later stage investors who are now taking the preferred share director board seat, and have stage appropriate resources for those companies. Or the resources that we provide, the frameworks of thinking, that the payloads we call them, are suitable for the earliest of founders, for pre-seed seed founders. The Series B that can get you into major corporations to build a partnership, that's what they're going to bring at the later stage. But it's important at that same time for us to remain in the room to some degree, because now we have the founders back. We've been there since the beginning. We understand the arc of the company, the journey that the founder has been on. And so whether they're coming to us privately one-to-one, whether the other board members come to us about a trait they might notice in the founder, we have this perspective from the board level that other founders don't have, or excuse me, other board members don't have, whether it's about the founder or about the company. And so the arc, the entirety of the board journey from a board director seat is as important as getting on the board to begin with.
And what do you typically see as board? What's best practice for pre-seed, late seed, uh, board construction, like two founders and you,
Yeah,
someone from B, and then what should people expect when they're doing a 5 to 10 million Series A?
yeah, that's about right. 2 founders and me. We certainly don't want to be in a scenario where investors can have control of the company. Oftentimes, we do in the financing documents. There are blocking rights. The majority of the preferred shareholders need to approve something if you take on debt or things like that. But for the most part, the founders are in control of their company early on. It's interesting you ask, because the next becoming a better board member session I'm hosting in November, we're talking about bringing on an early independent director, and when that's appropriate and what industries that's appropriate in. Healthcare is one that jumps to mind, because so often there's specific nuances and misaligned incentives in the healthcare system that an independent board member can really serve well early. Um, others, enterprise software companies, maybe not as necessary to bring on an independent. Wait till the Series A, potentially adding a second director and then an open independent position then. So just to be specific on your question, it'll usually be 3 of us to start. If we're capital efficient and get to the A, we'll add a Series A preferred director. Seed director stays on for now, and then we create that independent seat and fill that as we find someone amazing. Then you get into Series B and beyond. It tends to change. That's where the seed director may step off, go to observer, create other sort of advisory boards around the company.
Makes sense. So I understand you guys will typically be in 24 or so portfolio companies with a single fund. What percentage of the dry powder of the fund goes to get that initial position, and what percentage of the fund would be follow-on investing?
It's great. This is good because we look at this a lot. And interestingly, as our fund has grown a little bit and our initial check size has grown, the ratio of 4-to-1 follow on to initial check has actually shrunk down to between 2 and 3, depending. Overall, so if you have a $30 million fund, 10 million to new, or excuse me, 8 million to new, maybe 24 to follow on, because you can recycle some of that capital. So it's 3-to-1, 4-to-1. Much like at blackjack in Vegas, you need to have your tall stack of chips on the table when you get the blackjack. That's the only way to win. If you put the same amount of money into every company inside a fund, you will always drive middling returns. You will never drive outsized returns in this business.
Okay, so you're a big believer of invest early. Time will tell which ones are doing better, and then write much bigger, almost all chips in on some of those better
That's right. I
performers.
mean, because we'll write 500. Let's call 500,000 for easy numbers. We may then write $1 million into the Series A, or maybe another 500 into a seed or bridge, then $1 million, $1.5 million into the Series A, and then potentially some into a Series B as well. And so, do the math. You got 3 or 4 times that initial $500,000 check into the company after that first investment. The hardest part is that while we have information asymmetry and we know what's going on inside this company, it's not clear. It's oftentimes you don't want to throw good money after bad. You don't want to just write a check to save the company because the founders have become a good friend. You have to let companies die in the portfolio. And that's certainly one of the hardest things. And one of the things that my mentors in this business have told me, that, sometimes you just got to say no, and it's painful and it hurts, but it's always the right decision.
Yeah, I know. It's tough. And even when people say, "Can you give me a list of all your CEOs for me to do diligence on before I invest in your VC fund?" I'm thinking like, well, this one we did not follow on, and he really is never going to forgive us for that, and it was the right thing to do on behalf of the portfolio construction and everything. And we did everything we can to help him not run out of money. But, just feeding it with lifelines, you can't do it.
And you got to give the LP that guy's phone number, right? And the reality is the rationale and the explanation for why you didn't follow on should be clear and understood. And really the founders should understand that they have poorly executed. The market has moved on them. A competitor came in and took all the air out of the room. Whatever the reason is, should have been articulated clearly to that founder, and therefore not be end of days.
An emotional thing. And so talk about some of the other ways you add value. I know, you've over the years shown me a lot of companies, so you're really helping them raise money from other VCs. That seems like a big part of what you do. What are some of the key things that you do other than your check didn't bounce when you do write them?
You name one is follow on capital and attracting. A founder has to attract customers, talent, and capital to their business. So we provide the early capital. They then have to go attract customers and talent. And so those are the things we help on. We are our third partner. We're a team of 4 here at B. Our third partner is a portfolio ops partner. Experienced guy in his late 50s. He's got all the arrows in his back dripping with blood, we joke, because he's been there before and he understands. And so he spends all his day building systems and efficiencies to help connect the founder to those other 2 resources, customers and talent. Talent's the hardest. We have lots of tricks, trades, areas we go. We now have a portfolio of companies that can support there as well. And then customer connections, hookups, and then strategic, either investors or customers as well. So those are the big stroke things we do. I do spend a lot of time getting the company investable ready for the Series A. There's certainly a diligence and a scrutiny that goes along with that. No different than the conversation we just had about the board and the governance and the organizational presence needed inside the company. That has to percolate through the entire business to get to the Series A. So those are the things we help with. Now, what do we do specifically? We have what's called our B Partners Bench, always growing list of advisors and cool people from our journeys, guys like you that we can connect to when there's a specific ask from a company, or when we think about potentially outgoing, hey, I found this resource, and Andrew, like we talked about this morning, I found this resource. How can I best connect that to the portfolio? So we actually at B are working on a lot of internal products, software tools, because we think about ourselves as a market network in that sense. But those are the things we do. Now, then specifically to to have the data foundation and understand what that company needs, we have to have the transparency. We have to have the accountability in the company, which
Sure.
comes back to the governance of being on the board. Because if you have 80 companies, it's hard to have that. You have to have a different system.
Yeah, we've even with some of our early investments try to train the entrepreneur on good communication. Like some CEOs are sending out the same metrics. Here's exactly how we're doing. This was planned, communicating like every month or at least every quarter. And then we report to our LPs. So we're actually there's always two companies delaying the LP newsletter on
Mhm.
trying to get that information. I think one day we'll have like a perfect card stack of like the company has e-shares, people are digitally saying click invest and the share price is there and that flows right into us and an LP can log in from Singapore and see how his money is doing, going
Cool.
all the way down to share price.
Yeah.
But right now it shows you how in the cave we are, chasing people around with spreadsheets on some of that stuff.
That's if you have a share price. If we invest in safes and convertible notes, we don't even have a share price. So we can't even provide that data. And we as an asset class, as a pre-seed seed investor group, are getting better at this type of reporting. But I think our LPs know this is a longer term game. These paper gains are worth the paper they're written on. Where the funds start to show meaningful growth to 3x multiple funds is going to be at the later stages for us. Even if you go from, you do a very efficient process from pre-seed, maybe you skip the seed and go to the A, that position might be marked up 4 or 5 times, but that's not going to mark up the fund 4 or 5 times. That's only one position in the fund. And so this is an area where I've certainly learned in my 7 years about portfolio construction, fund management, fundraising. You don't learn that at an angel fund doing the due diligence. You learn how to do the work.
Yeah.
This area of the business is a whole different side.
Yeah. Well, there's a lot of similarities in portfolio construction and strategy with us. We were doing about 20 to 30% of our capital to get into a position of 25, thinking if
Yep.
it's more than 25 and one of them is a real hit, it won't have the impact if it's one of 90, right?
Thing
Where
you can't own as much of that company.
right. And then we would say all chips in is never put more than 10% of the fund into one deal. But if we do all chips in on 5 out of 25, that's half the money. That's half the fund really concentrated in 5 deals with diversification because a rocket could even blow up in there. So there's a lot of thinking of that. I jokingly say it's like Gordon Gekko in the movie Wall Street. He goes to prison for insider trading, right? But those companies are public, so he can flip them the minute after he has, blue star information.
Yep.
But if in our privately held companies of venture capital, we're have information rights or board seats, and you're making customer introductions, and if you have like a big customer introduction goes through, Gordon Gekko would call that a buy signal, right?
Yeah.
So that's the legal, fair, legitimate, encouraged, hands-on, smart money that
Insider trading.
we're
That's right.
helping all we can. I know that, you're going to re-up in a deal. Benchmark's going to lead it. We'll put a little bit of money on that next round.
Yeah. No, it sounds like we have similar portfolio construction thesis, and that is the way to win. Venture certainly follows the power law curve. 80% of your returns are going to be driven by that one company. Got to have the one of those 5. It better be one of those 5 major slots in the portfolio, because if it's not going to return multiples of the fund.
So when you're investing, how do you think of the exit and dilution and what sort of multiple you can make? So if somebody's offering you invest in this at 150 million pre, in order to make a 10x with no future financings,
Right.
you're looking at like a $1.5 billion exit. Is it plausible to get that? Like, what is some of your thinking on valuations?
That's right. We track a number called enterprise value to return the fund. So if a $30 million, our current fund is 40 million. So a $40 million fund, if you own 10% of that company at exit, that company has to exit for $400 million to return the fund once. That's without any of the dilution that you mentioned, holding our position. So that assumes that the company can be capital efficient, or that we can keep our pro rata into these bigger and bigger rounds, which gets harder as the rounds get larger. And let's not forget, $400 million exits are also very rare. So it's a tough business. Venture is not necessarily a good business. You have to get lucky, and you have to be mindful about where you allocate those chips because we don't have an infinite stack of chips at the pre-seed. So enterprise value to return the fund is that metric. And the reality is like, it probably grows over time because we get diluted. So if we own 10% of the company and it's 400 million, then we get to 8, well, then that number goes to 480. And so that really number is only going to grow over time. There are scenarios where we can pick up ownership in a bridge round, potentially an efficient Series A, where we can buy an extra point of the company here or there. That also gets expensive. We do our best work at the early stages, so that doesn't necessarily make sense either. So this is one of the hardest things we deal with at the pre-seed.
Okay. And what do valuations look like when you're investing? If these
Sub 10.
companies are pre-revenue, what's a
Yes.
range of realistic valuations on a deal that a lot of people want to get into, or you maybe saw something others didn't?
Yeah, that's right. Either way, sub 10. So 2 to 10. I mean, we've done some things where we have a really small check at a 2 cap into an amazing founder, and she goes and tries to figure something out. And then we'll go for that initial check around as high as a 10, maybe 12 with a new fund, depending on the scenario. But that's our range.
And so if these things start selling for sub, you hear a lot of people say, "Oh, what unicorns have you invested in? Do you need a unicorn to return, to be in the top quartile, top decile of the asset class?" What do you think are realistic valuations that still drive your model?
Yeah, right. I mean, that's the enterprise
Can you
value.
sell at 50 million and say that was a good hit?
Not really, because the enterprise value to return the fund is 400 million. So 50 can potentially support on recycling. We can talk about that in a sec. That can be a good outcome rather than going to zero. You make a kick save, that money goes back into the fund, can support one of those 5 positions. That could be your winner. So it's not a bad thing, but those aren't going to they will only meaningfully add to the fund returns if that money is recycled and then put into a winner.
So what is your policy on recycling?
So we're allowed to do, so quick fund math is about 20% of any fund over the life of the fund will end up as fee overhang. So $40 million fund, we actually only have $33 million to invest over the life of that fund because we take fees every year to pay our ongoing expenses. So we're down to 32. We actually have to return 40 million to our LPs to then get into what's called carry. So the goal is to get as close to or above that 40 million invested as we can. Our fund documents allow us to actually invest 115%. So we can go to 46 million in that fund invested capital. Well, how do we do that? Well, we have to take the 32, create some maybe smaller outcomes, like a $50 million outcome where we turn $1 million into 5. And instead of distributing that to LPs, we put that back into the fund to get them close to 100% of their 100 or more percent of their investment in us actually invested in a portfolio of companies. But that's efficient.
And there's no management fee on that recycled cash, or is
No
there?
management fee on recycled cash.
No
No, and
management fee.
our management fee steps down over time. So we have an initial investment period of 4 years. So we have a vintage 14 fund, which is probably when we met. And then we have a vintage 2018 fund, excuse me. And then we'll have a fund next year, hopefully, so vintage 21. So 3 to 4 year fund cycles works for us, both to support the ongoing operations at B, and then also because these companies take a little while to mature. We need a few years to deploy the capital, and then we have the reserves that go into that fund, and then we start making new investments out of a new fund.
Okay. And with COVID, how, have you been taking face-to-face meetings, walking meetings, or safe outdoor lunches?
Yeah, I'm probably not the right guy to talk about this.
Okay.
I'm from a small ski town in Idaho where all my buddies got COVID in March before they knew what was going on. And so I had some exposure to it, and not that I got it or didn't, but I have been, while respectful and mask wearing since the start, I'm personally more open to a walking meeting. We have a beautiful deck here at the office where I've hosted a few people. But we've made investments over Zoom, no question. And we're already technically enabled here in Silicon Valley in our jobs. And so we were doing Zoom meetings anyway.
Sure.
I personally like to meet people in person. It's part of why I like this job. We always do a breakfast or a beer before we make an investment. With COVID, we haven't been able to do that. We'll do a virtual beer, whatever it may be.
Yeah.
But I do think this fall, we'll see some more sort of personal walking meetings, being outside a little bit more.
Yeah. I mean, I was home for October, which is one of the best months to be in Silicon Valley anyway.
Beautiful here, yeah.
Beautiful. But Not that many meetings. So like I'm in Palm Springs right now with my kids doing distance learning and me doing everything on Zoom
Right.
until things get back to normal. And what about online demo days? I mean,
Hmm.
I see you at almost every demo day that I go to in the real world, but like it used to be, Y Combinator was 2 days of like 210 companies, each pitching for I think 6 or 7 minutes. Now they're doing it in 1 minute, and it's kind of interesting. You don't have time to say, "Oh, I'm not going to listen to that life science one." They kind of
Yeah.
hit you in a minute. How do you, how are you responding
It,
to the online demo days?
couple things. One, we've sort of been realizing over the last 2 years that accelerators and demo days aren't the best source of deal flow for us. At the pre-seed, we're almost an alternative to demo days where the founder kind of knows what they want. They want not a 3-month partnership, but a 10-year partnership. We're certainly less dilutive than an accelerator will be. So we found ourselves as an alternative. Maybe it's more experienced founder. Maybe they have the team together, because accelerators are very expensive to founders, and I don't think that they all appreciate that going in. That said, that doesn't answer your question. One of the best parts about demo day was seeing all the people around, changing ideas, changing deal flow. What are you looking at? Oh, I should send you this one that might be emerging for Series A, because a lot of the investors there are Series A investors, either buying an option or just kicking the tires for that follow-on round. So to me, that's the biggest loss on the demo days, is
Yeah.
not seeing guys like you. On the other hand, um, it can be very efficient for us because we can see the list of companies and not necessarily waste a bunch of time wandering around. We can get to the ones that are on scope, as we all like need to have a focus. Also, I've noticed that the accelerators now have to do a little more work in terms of trying to match founders with companies and, excuse me, founders with investors. So recently, before a demo day, the head of the accelerator said, "Hey, here's the 3 or 4 companies that you might be interested in." She was right on, and I ended up taking first calls with all of them ahead, and then being able to watch them on demo day. But again, you're watching somebody talking to a computer like I'm doing now. It's way easier than standing up on stage in front of 1,000 people. So that is one thing I'm looking forward to coming back, but it's not necessarily for the discovery in the deal flow. It's for the diligence on a founder who's presenting when the thing breaks down, like how do they do? And it's for building the network of other investors.
So as far as deal pace, how have you been doing before COVID, and how are you doing now? Did you
Yeah.
slow down a little bit with this uncertainty, or?
Yeah. Um, we only do 5 a year, 5 to 6 a year. I mean, our investment period is 4 years, 24 companies in a portfolio. That's 4-year investment pace. So some years we maybe do 7, and some years we do 5. So we're really slow anyway. That's deliberate on our part. That's the way we're building the firm. So to answer your question about COVID, interestingly, in the first quarter of this year, we weren't going to make an investment anyway. We got to early March and we hadn't found anything that we were even close on. So we weren't going to get there in the first quarter. Even if we found one the next day, it's still going to take 30 days to close. So we were sort of scratching our heads around valuations. We were cleaning the deck a little bit. We were like, hey, not that it needs a reset. We weren't saying that, but we were sort of slow anyway. COVID hits. The first thing we have to do is triage the portfolio. We do have reserves. You got the break glass, right? And so I talked about 3 to 4x follow on. That's a reason, because out of nowhere comes a global pandemic. So
Yeah.
we were actually didn't make our first investment this year till the second quarter, till the end of the second quarter in June. Found that company in May, it closes in June. So we were a little slower out of the gate, but now we're right on pace. We've made 3. We have a term sheet out for 4, and we're going to issue another term sheet next week. So that would be 5. Which leaves us a slot if somebody comes along in the fourth quarter, or another VC is leading a deal where we join rather than lead. So we're actually, overall, we're right on pace this year.
Okay, that's good. That's good. And of your portfolio, did you see, and even feel free to compare this economic downturn or whatever it is, it's almost like winners and losers of COVID rather than a downturn for the whole
Yeah.
world. But compared to 2008 and 2001, did a lot of your companies say, we got to recap and have a 24-month runway to sail through this uncertainty? Or like, did you see a lot of investing activity
Yeah,
in March, April, May?
you bet. That's exactly what it was, Andrew. It wasn't as a recap, maybe because we're so early. It was like, hey, why don't we extend the round? We'll take some dilution. Maybe we'll do, we did a priced round, so let's just do a safer convertible note on top. Another reason that we like priced rounds, it gives you more flexibility downstream. You understand what percentage of the company you own and so forth. So um, we did see some extensions adding to coffers, because if you're in a position of strength, that's much easier to raise money. So that's what we were doing for the better part of the end of the first quarter into the second quarter.
So what percentage of your companies raised money triggered by COVID, would you say?
Fund 3, which is our new fund that we're about, I think we have 16 positions of the 24. I'm looking at the portfolio wall here. I would say that 6 of those did 6 of the 16 did some sort of extension COVID related thing. Either they did or are doing it now as a result. So
Yeah.
Not 70%, maybe 30 or 40.
I think COVID was more beneficial and less, damaging to most of our portfolio companies than they originally thought. And I think some of them raised money at the same price and terms as the last round to just make it quick and easy and say, I'm a little less sensitive to dilution during COVID than I was before COVID. So a lot of these founders kind of raised a bit more. And I think that VCs kind of opportunistically increased their ownership percentages in some of those companies. And then
that was one of them for us. We not take advantage, the wrong word, but opportunistically the founder was like, I want to add some money. And we're like, great, well, we'll top you up because we didn't get our full allocation the first time, or we had to carve ourselves back to let somebody else awesome in. Great. So we did that.
Yeah. I mean, if the founder wants to do it and say, look, don't even run a process. Let's basically just do a rights issue. Everybody who wants to do it, these are the terms. The business appears to be doing better. So this looks like a pretty fair valuation. And we don't know what's happening. I had a call to London this morning and they said all restaurants are closed and they're in a total lockdown. So it would drive your Wyoming, Montana guys crazy. But well, listen, this is great. A closing question. What investment themes are you most excited about? What technology do you really think is going to change the world in 2021?
Yeah, I like that. Kind of 2 areas. We have 5 investable areas at B, 5 vectors we call them. So I'm going to highlight 2 of those vectors. One is biological machines, synthetic biology, computational biology, the merging of what we can do with a computer, what we can do with biology and nature, and what that can make. That certainly covers cellular agriculture, clean meat, if you will, going forward. We certainly know in our hearts that meat, real, legitimate meat, dairy, will not always have to come from the field. It can come from a lab, yet be biologically the same exact thing. So that is exciting. That also takes a long time. Some of these companies are longer to market, and we're investing in both the brands and the companies, as well as some picks and shovels that support those synthetic biology companies.
By the way, Garrett, food. The more I learn about food, and I'm also excited about like plant-based tuna and all the effects that these things have. But the more you learn about food, it's like this is more screwed up than the U.S. political system. You've got cereal in the United States that's illegal in Canada because it's telling the brain you're still hungry, even when you're not. Like there's some nobility of room for some disruptive food companies.
Yeah, and then food security too is an issue around that. One of our recent investments in Canada, that's in this space, that's their main goal. It's cold up there in the winter and they don't have access to farms like we do here in California. And so food security is also an issue in that same vein. So that's exciting. It'll be a long time. That's the kind of stuff that venture capitalists should be investing in. But we have to be patient, especially at the pre-seed where our cycles are already longer. You have to be patient there. The other one I want to highlight is edge computing. That's kind of a big thing. But as you push the actual compute out closer to where it's needed, where the data is gathered, it opens up a lot of opportunities. A fun one to think about in this space are drones. Computing on that drone, on that aircraft, is really important. You're not going to be able to fly a drone on a delivery across the bay if that drone has to send a signal back to a cloud server, have the cloud server say, yep, that's an aircraft that's intruding, you need to take maneuvers, and then go back go back to the drone to take that maneuver. That compute in that situation has to be done at the edge. That's interesting because then it allows for the package delivery, it allows for the pipeline inspection, it allows for humans to be out of harm's way in certain fields. And so as compute gets pushed out to the edge, what then opens up, what opportunities in different business verticals are we going to see? So those are two that I think we're very excited about going forward.
Awesome. Well, listen, Garrett, good to see you. Ping me on that next governance session. I'd love to join that one.
Yeah.
And I'll be back in the Valley December 1st, and hopefully we can go for a walking meeting sometime soon.
That sounds great, Andrew. Appreciate the time today.
Okay, thank you. Cheers.